Is the market overheating? I mean, the question of, are we in a bubble? Is this a bubble? We've been talking about that quite a bit. Lots of folks in the world of finance have been talking about it. But are we in a bubble? Is a bubble brewing of epic proportions? That we can learn something from the past, and some of the worst stock market bubbles in history, do they connect to what's happening today? I've got 3 ideas. That coming up. My name is Mike Bernard. I am the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. So, are we in a bubble? Is the stock market in a bubble? And I think for many of us, we can look and say, yeah, I mean, there's some bubble behavior here. Massive speculation, the most, margin debt, so people borrowing money to invest ever on record. There's some bubble behavior happening. And yet, just a couple days ago, if you watch the daily videos, just a couple days ago, I talked about how, there's a serious case to be made for today's optimism in the market. I mean, the stock market being as high as it is. That makes a lot of sense. And for the foreseeable future, seems like we should be optimistic. I mean, the consumer is healthy. People are comfortable taking risk in the markets. We've got fiscal stimulus. We've got Federal Reserve stimulus and accommodative financial conditions, housing market surging, all sorts of things. But I started thinking about, even though I just did that video a couple days ago, this weekend I started thinking about the risks. All right, well then what are the risks sort of brewing beneath the surface? And there's one risk that's starting to present itself right now in interest rates. We'll talk about it here in a second. And I thought, well, what could rain on today's parade? And then I started thinking about, okay, well, what are my big 3 that are, troublesome today? And then I started thinking about history, and I thought, oh my goodness. Today's risks sort of coincide with some of the biggest drops in the stock market ever, some of the worst bear markets ever. In fact, if you look at this list, now this shows the Great Depression as well and how awful that was, a couple of big drops of 80%, 60-some%. I mean, it was just awful, but ignore that. So really from 1940 to now, look at the list of the bear markets, the biggest stock market drops, and the one that we just saw in February last year was the fastest drop from an all-time high in history, and it was the quickest rebound as well. So you take that as a bear market, and because of what the Fed did and what Congress did, this is the shortest bear market ever, I believe. But so set that one aside. What about the 3 largest bear markets, the biggest drops in the stock market since the Great Depression? Are they connected to what's going on today? Well, let's look. Let's look. All right, so the biggest drop since the Great Depression was 2008. We all know that was the real estate crisis. It was a drop of about 57%, okay? And at that time, right, housing, and it wasn't a flash in the pan. I mean, the housing market and housing prices had been going up and building for years, almost a decade. And so that wasn't in and of itself a problem, but as people started to believe that, gosh, well, real estate only goes up in value. And then banks started to believe that too. And they started lending and letting people borrow up to the 100% of the value of their house because they just expected, well, it's just going to keep going. And then as soon as someone's house went up a little bit more in value, they would take out more equity. And in and of itself there, you would say, well, gosh, that problem would sort of be contained. But then things got worse, because Wall Street got wind of this and said, we can make money off of this. We're going to securitize these loans, and we'll package some really bad loans with some good loans, and we'll sell them to investors as overall good investments. And once the real estate market plateaued and started going down, it wasn't just the borrower that was hurt and then that bank that was hurt. It was the entire financial system because it was all daisy chained together. Well, unfortunately, guys, you guys probably know this. It's already happened. I mean, everything is daisy chained together. It very much is. And for a couple of years following the Great the Great Recession, I mean, they said, well, we'll never do this again. Well, no, we're back to the same thing. You can pretty much borrow 100% of your house to buy it. And housing prices are going up outrageously. The housing price index is far and away above where it was in 2007. And of course it should be, because, overall there's inflation, all sorts of things. But overall, I mean, the housing market is heating up. Many financial folks, you can see here, are concerned that things are getting overheated. At least for me, the folks that I talk to, anyone would love to sell their house at these prices. I would love to sell my house at this price. The problem is I can't just sell it and live on the street. I'd have to buy a new house, and I don't want to buy at these prices. And so it is pretty interesting. And when you look at housing starts, we're back at a level not seen in over a decade. And so there's definitely heating up happening in the housing market. And you would say the things that daisy chained everything together and caused the domino effect, I mean, that's already in place. So even though things have been a very quick recovery in the housing market, I mean, brewing on the horizon, I'm a little concerned about the housing market getting overheated and people getting back to the thinking that, well, home prices only go up and, my house is worth X number and so on. I mean, you've heard crazy stories about bidding wars. So I think this potentially is an area we're starting to see some threatening signs here in 2021 about how hot the housing market is. That's the worst drop in the stock market since the Great Depression. All right, second worst since the Great Depression, you know it, it's the tech bubble. And so 2000, 1999, I don't care when you want to call it, that was a drop of 49, almost 50%. And you guys know, I mean, you can't get this far in the game and have the idea of this time period being compared to the tech bubble as new. I mean, that's not a new idea. People have been saying that now. I've been saying it now for about 10 months. And take a look at this chart here. Goldman Sachs has been tracking an index of tech companies that don't have a profit. Tech companies that don't have a profit. If you have a loss, then you're in this if you're a tech company and you have a loss, but you're publicly traded, you're in this index. Look at how the price, the value of these companies has absolutely skyrocketed this year. It's not even close. Like, you couldn't even rationalize that other than, gosh, it looks like a lot of people don't care about today's profits. They care about future potential. That was the entire narrative back here. And they were right. They were just early, right? Amazon was going to take over the world. All sorts of these everything was going to go online. Yes, you were going to do your grocery shopping on a computer and have someone deliver it to you. I remember being in an econ class, someone talking about how that was going to happen. And of course, that company went bankrupt. But now it's actually happened. They were just early. But things got way overheated and subsequently created, at that time, the worst drop since the Great Depression. It seems like each and every day I see a chart that has something to the effect of, well, this hasn't happened since 1999, or this hasn't happened since 2000. And so it's very, very, very concerning how high valuations are compared to current profits. And so connecting 2021 and the current market environment to the year 2000 and the tech bubble does not take a lot of thinking. I mean, it just seems very evident. And so we're watchful. I mean, I watch the forward PE a lot. I'm not going to show you that chart right now, but the price people are willing to pay for earnings today, it's the second highest in history. And yes, I know when you do discount rates and the interest rates are at zero, it can make sense. I understand that. However, these are still second highest valuations in history, and we've got absurd speculation going on about companies that are currently not profitable. So interest rates and sort of the reason that leads back to, I might ask you, what was the worst stock market crash other than these two since the Great Depression? It was actually 1973, 74. That was a drop of about 48%. And what was going on there? Well, a whole bunch of things, political and otherwise, were going on, but there was also huge concerns over inflation. And you might remember, depending on your age, you might remember that during this time, and really from the 70s to about 1980, 81, we had surging inflation, where interest rates went way up, inflation went way up, and the government, it was a question by citizens whether the government and the Fed could actually contain this. And what are we seeing? Even just in the past week, we've seen the 10-year Treasury interest rate go almost straight up. The interest rate, the 10-year Treasury, is almost back to where it was a year ago before everything crashed, even though the Federal Reserve is keeping the overnight lending rate, the Fed funds rate, at zero, basically, okay? And yet interest rates further along out in the open market are starting to rise significantly because people are expecting inflation. Take a look here. We've got inflation expectations, predictions that are now almost a 10-year high. We've got interest rates, like I said, that have gone almost straight up, almost double in the past few months. And we've got hard assets. We've got commodity prices that are going up through the roof as well, copper prices and others, where you'd say, gosh, the whole world is sort of expecting inflation. And what else could be the result from printing $6 trillion and dumping it in the economy with another 1.9 in the holster, right? And so what happens? So let me tie all this together. Right now, again, this is my strain of consciousness here. Right now, I think, gosh, things are good, and investors should be happy with how things look today in the near-term outlook. But what's there to be worried about? Well, a little worried about the housing market heating up. I mean, and if interest rates do actually go up and the housing market starts slowing down, gosh, that could be problematic. Seems like people are taking on a lot more debt than maybe they should or are comfortable with. I'm very concerned about valuations. And gosh, the last time we had that was a result in a huge drop in the stock market. And all of that's sort of connected back to inflation could be a real problem. I mean, guys, when I look at my list, the top 3 things that I'm concerned about, they are connected directly to the 3 biggest stock market drops that we've had since the Great Depression. And they're all connected together. What if we have a housing crisis and a tech bubble combined with an inflation crisis? That could be a bubble of epic proportions. I hope that's not what's happening. There's one sort of entity that's connected to all of this. They're the ones that could help prevent it and get us through it and navigate this course so that we don't end up there. But I'm also afraid that they're the ones creating this, and that is the Federal Reserve. So all eyes on the Fed. Don't fight the Fed. However, with the monetary policy and everything that's happening right now, especially the statements that we've heard recently from Jerome Powell, and then you attack with it Secretary of Treasury Janet Yellen, I do fear that these risks, at least we're on track for them to be to be brewing all in tandem and create potentially the mother of all bubbles. So what should you do? Number 1, I would make sure your financial house is in order. I would. I mean, going back to 2008, you were rewarded if you had an emergency fund, if you had margin in your financial life, if you didn't take on too much debt and you had some equity in your house, and you weren't relying on speculation and the stock market the housing market continuing to soar. So make sure you've got a strong financial foundation. Same thing happened here and hyperinflation. Make sure that you're doing comprehensive financial planning with your certified financial planner, making wise financial decisions. So that's step 1. Make sure your house is in order. And step 2 is, once again, have an investment strategy where you are standing as close to the exit as you are to the entrance. Because just like in the tech bubble, Federal Reserve Chairman at the time, Alan Greenspan, said this is irrational exuberance in 1996. Things continued to grow at about 20% per year for the next 4 or 5 years before the thing dropped, before the bubble burst. And when it did burst, it fell 49%, just about back to where the market was when Alan Greenspan said it was too hot. I do think for the near term, the market does look good. I think it would be a misstep from the Fed if we did see something drop here in the short term. You'd probably blame the Fed for doing something. However, if we stay on these current trajectories, we could have an enormous bubble. So you got to participate while it's moving in the right direction, but be able to pivot and adapt if things change and change quickly. So if your certified financial planner is helping you with that, wonderful. If you don't have one on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with a K, wisemoneyshow.com. You can find us there as well, or just send us an email, info@korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.